Good afternoon, everyone. Brad Rourke here. Just getting, for some reason, the time got away on me. Next thing you know, it's quarter after the hour. So hopefully you guys can hear me okay, and the audio is fine and the video is fine, but happy Friday, happy Tax Friday, I guess. So I might wait another minute or two and just to make sure whoever wants to join can join in. I'm kind of like you guys probably are. I'm happy the week's coming to an end. It was a big week in America, or for the world, as a matter of fact. So if I'm looking over here, I've got some administrative things on my left. So Brittany, is the audio and everything okay?
Yep, everything sounds great.
Good, wonderful, great. All right, well, we'll get started. Let me just move this over my left here so I can get that stuff sorted out. All right, I think we're ready. Well, just a quick intro. Thank you very much for joining. Greatly appreciate it. So my name is Brad Rourke, Bradley Rourke. I've been with the Williams Group for 23 years now. I've been proudly to say I've been in your profession for that long. And so we have just a little bit about our company. We've got 3 business areas. One is accounting and tax, where we do bookkeeping, accounting, and tax work for our clients. And then we also do another financial service, which is transitions. So we do valuations and help buyers buy practices and sellers sell practices and do the valuations and help bring the terms of those transactions together. And then our longest-standing business is consulting. So we help practices essentially run their practice better and work with staff, organizational things, optical, you name it when it comes to practice management. So that's our three areas. So enough about us, and let's just kind of move on here. I'll click this over to get to the agenda. See if this is going to render reasonably quickly. Yes, good. So I said in the bonus, so you might not think it's necessarily a bonus, but a bonus topic being the tax platform, whatever potential party, so to speak, wins the House or the Senate. We just talk briefly about their various platforms. So in this case, since it looks like, well, Republicans won the White House, and then it looks like they've won the Senate, and then it's kind of, we'll see on the House. But so we'll talk briefly about the Republicans' tax platform, and then real briefly on the tax rates, and then tax reduction strategies, and then Q&A. So that should take us. I'm going to try and run through things pretty quickly. So I want to be done in a half hour. I don't know if that's possible, but we'll see. And then we can have some time for Q&A and get you guys out of here as soon as we can to be efficient with the communication of the information. So, all right. All right, Title 26 of the U.S. Code, that's our tax code. So I think everyone knows we got our Constitution, we got our Bill of Rights, and then we've got 53 sections or titles of our code. The country's run by essentially is run by this in a sense, our 53 titles and the Constitution. So I would personally argue, fair enough, other people might argue against it, that Title 26 is the most important of the 53 titles of our code. Apart number 2 for sure, based on the Constitution, but because nothing would happen, nothing would get funded. There would be no Health and Human Services, there wouldn't be any Department of Justice or Homeland Security, et cetera, without Title 26, because this thing funds everything. So that's my little plug for us accountants or CPAs or folks that can practice tax before the IRS and then support you as clients from a tax perspective. So Title 26 So let's see if we can get, yeah, so maybe we'll just back up a sec on just another really quick, brief plug, so to speak, on my view of tax practitioners, of which I am one. And we have 3 licensed tax practitioners with the Williams Group. And the way I see this is similar to attorneys, I guess, and doctors like you, licensed professionals, and your major objective is to take care of your patients. That's it. And so, and with tax accountants, there's some tax practitioners that will take care of the IRS in a sense, that they're in the. I find it that way in some respects, that they will take more of a position that Treasury or the IRS has, and that's not how we practice tax, or it's not how I practice tax. So I am in the camp, we're in the camp of you, the client. And so one of the reasons why I talked about the tax authority or the law, essentially there's in tax nomenclature or tax law, it goes from, there's basically 3 areas of tax that are authoritative. So Title 26, code itself, and there might be some changes with this GOP platform to Title 26. We'll talk about that briefly. So Title 26, and then there's the regs, the IRS regs, and those are authoritative also. And then there's essentially revenue rulings. So there's only really 2, other than the Supreme Court or tax court, ignoring that for a sec. When it comes to the legislation, on the codified legislation, it is Title 26, and then the regs, and then revenue rulings too. But revenue rulings are specific to a particular case or factual circumstances. So, some folks will look at IRS FAQs, those are not authoritative. The forms themselves are not authoritative. So we, as a tax practice, we look at the tax law. So when we go through this, you'll see that for the most part, we're going to cite the tax code section, and so we look at it from the benefit of you, the taxpayer, not the benefit of the IRS or Treasury. So there's 4 things I'm going to comment on with respect to the GOP's platform, and it wasn't a really big issue, I don't think, through this election cycle. But both parties had their platforms either verbally expressed throughout the candidacies, and then on their Republican and the Democrat websites, some tax matters. So the first of the 4, the Republican stated platform, is they want to continue the Tax Cuts and Jobs Act and essentially make it permanent. So it has a lot of benefits for you, a practice owner. So the Tax Cuts and Jobs Act came into legislation in end of 2017, and then it was from basically Jan 1, 2018, and then some of it is set to sunset through 2025, 26, and 27. But there's certain provisions that the GOP would like to get through. But I am going to just make another, I guess, comment back to the law. So let me just go to tell you the situation here. Let me go here, the webinar. Yeah, the results. So as you know, let's see, is it gonna? Yeah, it's gonna throw this up. So that's good. Let me make this a bit bigger. So as you know, the parties and the president or whomever can't just say, well, this is going to happen, because obviously to amend Title 26, it's got to run through Congress. Both need to agree, and the president needs to sign it. So as I mentioned, both races are extremely tight in terms of the number of. Let me get rid of this. No, thank you. Yeah, in terms of the numbers in the Senate and the numbers in the House. So it looks like The Republicans have 53, so that's a slim margin also. And then it looks like the House is going to be very slim also. So when we talk about, so right now it's 199 to 211. This was updated, I don't know, 3:25 Eastern time, so a couple hours ago, but there's still 22 seats. So it's going to be really tight. So my point there is that, yeah, you've got to get, any laws got to get passed through Congress. So we'll see. So these things I'm going to talk about may or may not occur. So with the Tax Cuts and Jobs Act, the standard deduction was basically doubled. You remember in 2017 and prior, it was around $6,000. Now it's, I think, 14,600. So a significant increase in the standard deduction. So I believe is, I don't actually know that when that's going to sunset, but it is going to sunset unless it gets permanently put into law or extended. Same with bonus depreciation. So bonus depreciation was a really big deal in 2018, 19, and 20, and it really helped our clients with respect to when they bought equipment or whatever, and it could be used equipment, even 100% could be deducted. So they're looking to potentially extend that. The qualified business income deduction came into play also in the Tax Cuts and Jobs Act. And that's a really great deduction for practice owners with, because the flow through or pass through income before was, so you got $100,000 of pass through income on your K1, before that would all be taxed. But now with this 20% qualified business income deduction, there's a 20% deduction. So effectively only 80% is taxed. So it's a great deduction. So they're looking to potentially extend that or make that permanent. Individual tax rates were lowered in 2018, depending on the bracket, a couple of percent per bracket. So they're looking to extend that too. And then the child tax credit was increased from 1,000 to 2,000. So yeah, so most of these things will help you as taxpayers, in my view, if those things are actually get passed through Congress. So let me just move on to the next. Maybe I'll just hit the plus sign. Now that increased the size. So let's just see here. All right, there we go. So yeah, the next three of the big four, so to speak, of the platforms of the Republicans. So they want to decrease the tax rate, the corporate tax rate to 15%. That doesn't affect too many of our clients, but it was reduced to from, I think it was 37 prior, but it was graduated rates, et cetera. It's more complicated than that, but they would like to decrease the corporate tax rate to 15%. So that could be a really good planning opportunity for practices that have excess cash that they could potentially just have a C corporation, because this is for C corps. And most practices are practicing through limited liability companies, PLLCs that have elected S corporation status. So this 15% does not apply unless you have a C corporation. So if this goes through, there'd be planning opportunities to, if you have excess cash, you don't need it personally, even though we as Americans, we love spending money. But if you want to retain any money and invest it, you could potentially keep that money in the corporation at 15% tax and invest it. So that's that. And then interesting on the no tax and overtime. Yeah, I think that would be wonderful for you all with respect to the employees. Yeah, I think it would be great if that would go through. But there's a tips exemption too, but that typically your staff are not getting a lot of tips. Probably once in a while they do, which is great. I like to tip everyone. I think it's just if you're making more than people are willing to work, man, it's just great to in my view, to tip them well. But if the no tax and overtime goes through, yeah, that'll be great. I think it'll help your businesses and make people more. Yeah, you get paid time and a half or whatever the case may be, plus no tax on that. That'd be wonderful. So that'd be great for your staff. Oops, that was. The fourth one was tariffs. So I think that one of the ways that might affect you is increased equipment costs. So I said 60% tariffs potentially on, and that's what I think Trump was saying, or someone was saying, or I don't think it was an official part of the party line, but he's just been talking a lot about putting tariffs on other on imports. So that would be on the negative side for you, is potentially if any of the equipment you're buying is in a country where we're going to get hit with tariffs. So that would definitely increase the cost of equipment. So I guess on that end, if you want to buy some equipment, now might be the time to do it. But that's I don't know. I usually don't like or recommend making business decisions based on potential tax consequences, because like we talked about, it's got to go through Congress. So so I've got individual tax rates. I usually like to look at those. So let me just bring those up here really quick, just so you can get an idea of what rates you're in. I've highlighted these, so it goes from, these are marginal tax rates. So for the first 9,800, you're taxed at 10%, then 12% on the next 30,000, and then it jumps up to 22 from 40 grand to 85. So, and then up to 163,000, you're still in 24% bracket. I'm just talking about single, essentially doubles for married. But this is where most ODs are at for the most part. Some are up in the 32, but one of our objectives is to get our tax clients down into the 24 and out of the 32% tax rate, because that gets a little hefty, especially if you're in a high tax state. It can really add up and take a good chunk out of your pocket. So that's the tax rates. All right, we'll talk about a few things you can consider doing to minimize your tax. So the Augusta Rule is so that's section 280 AG, and it's a fairly uncommon or not well-known deduction. So you can rent out your home, or if you've got a vacation home or an Airbnb property, whatever the case may be, you can have your company, your practice, your entity rent out at reasonable market rates for 14 days of the year. And then when, so you're taking that, say you rent it out for an afternoon, 14 afternoons, say $1,000 per afternoon. And reasonable is based on what's reasonable. So Manhattan, you could probably rent it out for $5,000 or $4,000, or if you're in a major suburban area, you can look at hotel rates and say, okay, what are meeting room rates for an afternoon or something. So, you can, your house is probably nicer than most meeting rooms, so you could offer, argue a premium on that, but so say $1,000. So that's $14,000 you can deduct in your practice for having management meetings or board meetings or whatever in one of your other properties, or your home, and then deduct that. So it's a $14,000 deduction if you at $1,000 per company meeting that you're going to have at your home. So it's a really great deduction. So on 14 grand, if you're at 30%, that's a $4,000 savings over the course of the year, and you can just roll that through every year. So the Augusta Rule is great. We recommend this to our clients. We have several clients that do it, and they do the research themselves in terms of what the local reasonable rates are for meeting rooms. So that's all we'll say there. But it's a great deduction that's not used all that frequently. So the Augusta, it does relate to Georgia, Augusta, I guess, where the Masters is, because I think historically that's where there's some lobbying done, because I think people were going down to watch the Masters, and I don't know all the details, but I do know this deduction is a great deduction. Another thing that if you're one of our clients, we're trying to do this for you, or make sure that you have this done, is establish a home office. It's a really great deduction in a number of ways. So Internal Revenue Code Section 2080 AC, So it allows you to have an administrative home office, but it has to be exclusively for business and not used for other entertainment or have a bed in there or just, whatever. It needs to be exclusively used for business. So once you establish a home office, then you can deduct, let's just say you've got 5 rooms in your house, one of those rooms is an office. That means you can deduct 20% of your home expenditures, including depreciation. So all your internet, everything. So you just would bill the company, your corporation, your LLC, or whatever the case may be, for your home office. So it could be 10 grand-ish, 15 grand annually. And then once you have your home office established, you can now deduct your commute going back and forth from your home office to your practice's office. So you cannot do that as an employee, in a sense, because you cannot deduct your commute going from your home to your place of business, but you can deduct the commute going from your home office, because that's office to office. So it's a really great deduction, and in my view, every single practice owner should establish a home office and then take that deduction. All right, let's move on. Yeah, this is another deduction that we advocate for. If you have children or parents, that you pay them out of your practice. It can get a little complicated if you've got multiple partners or something, but there's other ways to structure your practice entity and how that gets structured so that certain individuals can do this. But that's it's more complicated. It takes me a little while to explain how to get that done. But if you have children and you can pay them up $14,600, the standard deduction, and have them pay no tax on it. Whereas you're at 30%, 32, whatever, you're on that same money, you're paying $5,000 of tax. So it saves you $5 grand of tax, and you can essentially fund your children's education or whatever the case may be. Same with parents or grandparents. If they're at a low income level, you can pay them to do whatever it is. So it needs to be reasonable, but reasonable is there's a lot of leeway in reasonable. So you might think, hey, my child is the best looking child ever, so I'm gonna pay him or her whatever, 20 grand or something for promoting the practice or putting their photos up on your website. So as long as these things are documented, the rationale, the reasons, when, etc., yeah, you can pay your children or pay your parents. So it's another great deduction to reduce your overall tax burden. Okay, let's see if for some reason I'm having a little trouble moving these over, but we'll get it here to the next slide. So that's going backwards. I might have to just escape out of this and just go this direction. Yeah, that'll be fine. So because I can toggle through a lot easier, it seems. I'm technically challenged, obviously, moving these slides forward, but yeah, another thing you can do is, for example, I invested in a bunch of cryptocurrency, a number of altcoins, and Bitcoin's obviously done quite well, but some of them, I don't know, I bought maybe 15 different altcoins and they've just crashed and burned. But so what I can do, or what you can do, if you have capital losses, you can crystallize those losses, so to speak, by selling, say you've got, say you have Dogecoin or something, or it doesn't matter, or some other stock that hasn't done really well. So you can sell it and then have that capital loss. And then if you're still bullish on whatever asset that is, you can buy it again 31 days later. But now you've crystallized that loss, because say something was worth $10,000, it's went down to 3,000. You've got a capital loss that's sitting there at 7 grand. So you could sell it and then buy it again in 31 days for the 3,000. You're not out anything other than transaction fees. Now you've got a $7,000 capital loss. So you can deduct at least $3,000 against ordinary income every year. So you can take that, which is great. Or if you've got capital gains, because typically capital gains can only be offset against capital losses. So then you can offset your any capital gains you have in that particular year with by crystallizing your losses that are on the market, so to speak, but you actually haven't realized those losses because you haven't sold. So it's a great way just to minimize your tax bite. It takes a little bit of work to get that done, but i.e. do the trades, whatever is necessary to crystallize those losses. This is a little rare too. Since I grew up in a where it would have been a sin not to do 10% of your income and donate that. So, but then the argument is, okay, is it 10% of the gross or is 10% after tax or whatever? But regardless, if you do a lot of donations, the issue that has come into play based on the Tax Cuts and Jobs Act again is that the standard deduction was raised so high that some donations don't really matter. Say that you've got $5,000 of state and local taxes, you've got say $4,000 of donations, and then say some interest expense. And typically before, under those circumstances, you would itemize. So now there's no need to itemize under that because it's better taking the $14,600 standard deduction. Or if you're married, it's 29. That's a lot of deductions. So if your donations aren't that high, say you typically give $10,000 a year, what you can do is you can there's something called donor advised funds. You can set those up with a financial planner. So you could deduct $50,000. So you do all $50,000 in 1 year. Now you can deduct all that because normally those donations you don't get any tax benefit from it because your standard deduction is clearing all that. So really, you don't really get the tax benefit. But you can do that by stacking your donations. You can put them into a donor advised fund, or you can say, look, I'm only going to donate every 5 years or 3 years so that I can get my donations up or my Schedule A deductions up over the standard deduction. So it's just something to talk to your tax preparer about if that's something that you're interested in doing. But it can add up because our tax rates are high. So every dollar every dollar kind of counts, especially some families. It's just money can be tight. So I'm just going to a half hour in, so this is great. So I'm just going to roll through these pretty quickly, and then we can move to Q&A. So a few things. As of 2018, again, you could deduct all your inventory. So that's something you could do. You could purchase inventory before the year is out. But I just view, again, I don't like to, not even that I don't like to, I'm just simply not really an advocate of making business decisions based on tax consequences. Because, okay, you load up on a bunch of inventory, a bunch of frames or whatnot, and then you can't sell, say, 1/3 of them, and now, okay, that wiped out all your benefit of potentially buying them early. So, but that is one thing you can do. If you know you're going to need the inventory, you can buy it before your cycle, right at the end of the year, buy it, put it on the credit card, and then you can take that deduction this year. Everyone knows buying equipment. So there's also the $5,000 disabled access credit. So if you're buying equipment or say expanding the access into your building so that disabled people can more easily access it, or any sort of expenditure in your office, be it equipment or just access. So there's and this is an annual deduction. So if you purchase something that will benefit disabled people, then you can take $5,000 credit. So it's great. But say you buy a $15,000 piece of equipment that qualifies, then the first $5,000 is a full credit. Now then you can take the depreciation on the other $10,000. So the tax effect of that of this credit is pretty good. So everyone knows about retirement plans. So IRAs, yeah. So if you don't have an employer sponsored retirement plan, essentially simply IRAs, which are an employer sponsored plan, and 401ks. So you have $7,000 each from, and it go, I think it's $8,000 if you're over 50. So you can put up to 7,000 in your IRA, which is a great deduction. And simple IRA, same thing. You can go up to 16,000 a deduction there. And then I like simple IRAs because they're simple. 401ks are a lot of administrative work to maintain a 401k, but 401ks is kind of the granddaddy, so to speak, of retirement plans, because you have 23,000. I think it's 30,000 if you're over 50. So that's a lot of deductions, and then you can also have the company match. So yeah, 401ks are pretty great with respect to if you got a lot of excess cash that you're generating and don't need it right now, then yeah, any of those three works. HSAs are also great. Health, I'm going to get it wrong. Health savings something. Anyways, it's all right. So you can put up to $4,000 into an HSA, as long as, so if you have a health plan that you can only qualify for this $4,000 if you have a high deductible healthcare plan, then you can create your own health savings HSA and then put an additional 4,000 in it. And it's great because you can just leave that money in and it'll accumulate tax-free over time. And then say at the end, say 20 years down the road, you've got $200,000 in that because you invested it in something that's grown quite a bit. Then you could take all your receipts, if you're saving them for the last 20 years of healthcare, and you could just pay them all off. Yeah. So basically reimburse yourself out of the HSA, and you're good. So, and you can also roll these over to or donate them, so to speak, to your children when you pass away, so they can move on from generation to generation. So HSAs are great. We talked about C corporations a little bit. Yeah, because the 21% tax rate, which we have now. So when that changed in 2018, there was not a lot of movement. There was some from going from S elected entities, S corp elected entities, or partnerships moving to C corporations. But yeah, there's some advantages of having C corp because the tax rate is 15%. That means you're retaining 85%. You just need to leave that money in the C corporation, and then you can invest it. So in other ways. So we'll see if this 15% tax rate goes through. I kind of doubt it, quite frankly. There's too much political opposition to moving the corporate tax rate down that low. So I kind of doubt it, but we'll see. We always advocate that you keep your W-2 wages low. So if you're an S corp elected entity, you got two ways to take money out of your practice, out of that company, and that's through flow through. That's your wages initially, which accrue an additional 15% FICA. So 100 grand of wages, you're paying another $15,000 of FICA. And then on the flow, so if you make $300,000, you take out 100 grand of wages, then there's a remaining $200,000. So on that 100 grand, you're paying 15.3% additional tax. And on the 200,000 that flows through on your K1, you don't pay that 15.3 FICA. So if you want to keep the ratio, you could do it 25% wages and 75%. That's acceptable. So point is just keep your wages down as low as you think is possible, and we can recommend different wages, but it's a big deal because, like I said, on 100 grand or even 20 grand, that's $3,000 of tax every year if you reduce your wages by 20. So there's other credits. We might do another webinar or something on because there's lots of credits out there. The working opportunity credit is good because if you're hiring veterans or long-term unemployed, which I think is 27 months if someone hasn't been employed, you can get up to a $9,600 tax credit. It's more complicated than that, but essentially other 25% or 40% of the employees' compensation can go towards accruing for the credit. So it's pretty good credit. I remember going to this is several years ago, but I knew a guy who worked at Jimmy John's, and Jimmy John's hires a lot of felons, quite frankly. And so like guys that are in prison, and then they let them out, so to speak, and obviously not high risk. I'm not a lot familiar with all the details, but yeah, they go work at Jimmy John's and then go back to wherever they were staying. And so they were getting this credit. So something to consider. Because hiring veterans is great. Anyone that's been unemployed for a long time is great too. So that's, I've got a lot more other tips, so to speak. So we'll do another webinar soon, and invite your friends and family or whatever, your colleagues, and then we'll go through some more. But I think that's probably enough tax that you probably can endure, so to speak. But so if there's any questions, I'm happy to take any. I'm not saying I want to assert that I'll be able to respond to everyone, but if I don't, I will find out for you. So let me just see if there are any questions. So you can either unmute and ask a question, or you could type it in. So I think there should be something, and I can't see what you see on your screen, but you can, yeah, I'm thinking you can figure that out. If you do have any questions. Yeah, I am curious to see what's going to happen with the tax legislation going forward, but I don't think it's going to be like it was through 2018 and through the COVID years. Boy, we had a lot of tax changes. A lot was ran through the tax code, through Title 26, ultimately. So it's yeah, those years were very, very busy for tax professionals. And this is my email and my cell phone number. So if anyone text me, call me, email me with questions or tax problems or whatever the case may be, family problems. Tax accountants, we're good at, I think we're good at that too. I did not prepare any of my own questions. So if I don't get any in a minute or two, I think it's 5 minutes to the hour, so that'd be great. We'll wrap up. I am interested in the C Corp situation. If the corporate rate goes down to 15, because I think there would be some incentive for clients to potentially form a C corporation separately, potentially from their practice corp, to have excess cash invested be at pre-tax rates, which is it's almost like a 401k in a sense, that a retirement plan, but those go in obviously with no tax. But if the C corps hit 15%, then that's going to go at 85% you can invest. And over time, it's a lot. So, all right, guys. I don't think I see any questions. So, yeah. Thank you for attending, everyone. And yeah, I hope you all have a wonderful weekend and restful weekend. I'm looking forward to it myself. I'm sure everyone likes the weekend, but maybe some of your practices are open. You've got to work tomorrow, but I don't know, working is a joy. It's great to have the responsibility to be able to work. So I don't know if we couldn't work, I don't know. I don't think we would be as happy, so to speak, as we potentially are with having the opportunity to just bring everything we can to the table and do our best, take on responsibilities. So, which you all are doing as practice owners. So, yeah, I think it's wonderful. So, all right, everyone, I'm going to sign off. So, take care, and hopefully we'll be in touch.
Hey, Brad.
Uh-huh.
We did get one question.
Oh, okay. I missed it.
Sorry. Do you recommend separating professional income from optical sales? Do you see that question in there?
I do, yep. Yeah, absolutely 100% recommend doing that. We do that with our clients. You have to get to a certain threshold. If your income is, you don't need to separate them out. And if it's below, if your total income is below 250, I'll just bring up because I think I have the actual numbers here, but I won't bother trying to figure it out. I'll find it. But yeah, if your income is high, absolutely you want to split out your optical from your professional, because ODs have two activities and they're taxed differently. You have professional activity and you've got your retail activity. And that qualified business income deduction of 20%, it never phases out on retail. So you don't need to split it out on your books, so to speak, but you do need to split out those two activities on your tax return. And that's what we do for our clients, that we know that the QBI deduction is going to phase out because they're making over $250,000. So yeah, that's a great question. Yep, absolutely. We do that. And I will say there is a, like I said at the beginning, there is a FAQ, an IRS FAQ that says that you need to have a separate EIN. Yeah, but that is not authoritative. So yeah, the IRS can put that out all they want, but it's section 199A is the code section. And yeah, there's no requirement there in the code that says you have to have a separate EIN or a separate company for those two activities. But the IRS in their wisdom has said that you do. But no, that's just wrong. So yeah, we split out those two activities on for our tax lines. And so with your tax preparer, absolutely. And it's pretty easy in a sense that to do the split, because most practice owners, they know if their gross income, so you get $1 million of gross income, if it's a 50-50 split or 45-55 one direction or another. So then once you have that top line, then you're applying all the cost of goods sold to the optical, and then a percentage of the rent occupancy, your rent, goes over there based on the size of the optical square footage. It can be done on that basis. And your staff, okay, how much of my staff is in the optical area. So you can create it's just what we do is we export the profit loss statement that's all combined into a spreadsheet, and then we have that original column, and then we split out the two columns between optical and professional, and we just create two separate P&Ls for those two activities that equal the overall, and then we file the tax return on that basis. So yeah, great question.
Okay, that's all we've got now.
All right. Well, thank you, Brittany. I appreciate your help moderating. That's great. So, all right, everyone, have a good weekend, and I'll see if I can close this out.